Welcome back to The Explainer. Today, we're rolling up our sleeves and diving deep into the raw financial data of Solventum, ticker symbol SOLV. We're going to unpack the hard numbers to figure out what's really going on here. Is this company a hidden market gem trading at a massive, irrational discount? Or are we looking at a dangerous financial illusion? A classic value trap. Let's get right into it. To cut through the noise, we're going to follow a really strict roadmap today. We'll analyze the company across 5 key categories. We'll start with a quick snapshot, move on to valuation, dig into profitability, tackle their historical growth, and finally stress test their financial health. All right, Section 1, the Solventum snapshot. First off, we have to establish the sheer scale of the business we're dissecting. Solventum operates with a very substantial market cap of roughly $12.9 billion. So we are not talking about some under-the-radar microcap stock here. This is a formidable, large-scale player. And honestly, when a company of this size exhibits the kinds of extreme financial metrics we're about to see, the market pays attention. Looking at recent price action, shares are currently trading around $74.41. Now, that sits about 15% below its 52-week high, but it has actually managed to rebound roughly 19% from its recent lows. So we're definitely seeing some positive momentum. But overall, it's a stock that's really been knocked down a peg over the last year. Moving right along to Section 2, valuation. Is it actually cheap? That recent markdown in price really begs the question, right? Because the story told by the discounted cash flow analysis is undeniably compelling. Based entirely on their financials, the estimated fair value price is $98.52. Compare that to today's market price of $74.41, and you've got a stark, glaring contrast. The market is pricing this business significantly below what its actual cash flow suggests it's worth. And that brilliantly illustrates a massive 24.47% margin of safety. For any serious value investors out there looking for a bargain, a nearly 25% cushion is exactly the kind of metric that triggers stock screens and gets people really excited. You're essentially looking at buying $1 for about 75 cents. Further supporting that cheap argument are the multiples. Just look at the current price-to-earnings ratio. It sits at a remarkably low 8.39. Let that sink in for a second. That is a massive 50% discount compared to its very own trailing 12-month average PE. By almost every traditional valuation metric, Solventum is flashing bright green lights for a bargain. Okay, Section 3, profitability and margins. So the stock looks incredibly cheap on paper, but as we all know, a stock is usually cheap for a reason. Let's dig into the profitability metrics to see if the underlying business is actually generating quality returns. At first glance, things look really robust. Solventum boasts a very healthy gross profit margin of over 54%. That immediately tells us they have strong foundational pricing power. Plus, their net profit margin is a solid 12.92%. They are absolutely generating real profits from their top line. However, when we evaluate their returns on capital, we hit a massive, glaring discrepancy. Return on equity is a stellar 31.31%, but return on invested capital, it is shockingly low at just 5.25%. Why does this matter so much? Because a high ROE paired with a terribly low ROIC almost always means management is leaning heavily on debt to artificially juice the returns for equity holders. The core business operations just aren't deploying capital efficiently. Frankly, a 5% ROIC is a major red flag if you're looking for long-term compounding. Which brings us to Section 4, the historical growth problem. That discrepancy in capital efficiency leads us directly into the most concerning part of our analysis, and really the absolute core of the value trap argument. Over the last 3 years, this company has faced severe contractions. Revenue has been shrinking by nearly 22% annually. Net income is down over 15% a year, and earnings per share plummeting by an unbelievable 60% annually over a 3-year stretch. This is a company whose core footprint is aggressively shrinking. Adding immense weight to this concern is their cash situation. Remember, net income is just an accounting metric, but cash is reality. Despite generating $8.3 billion in trailing revenue, Solventum's actual free cash flow over the last 12 months was a negative $198 million. They are literally bleeding cash right now. When a company is shrinking its revenue by 20% a year and bleeding free cash flow, well, that cheap PE ratio we saw earlier suddenly makes a lot of terrifying sense. Finally, Section 5, financial health and debt. To understand if Solventum can actually weather this storm of negative cash flow, we absolutely have to examine their balance sheet. If you're going to turn around a shrinking business, you need a financial fortress. Unfortunately, their liquidity is tight. Their current ratio is barely above 1, and their quick ratio, which strips out inventory to show immediate liquidity, is sitting at just 0.75. If they had to pay off all short-term obligations tomorrow using their most liquid assets, they literally wouldn't have enough. Combined with a debt-to-equity ratio of 1.06, they have very little margin for error. And by the way, that high debt perfectly explains the inflated return on equity we uncovered a minute ago. So the crucial takeaway today is this absolute contradiction in the numbers. On one hand, we have a stock trading at a massive 24% discount to fair value, an incredibly low PE of 8, and fantastic 54% gross margins. But on the exact opposite hand, it's burdened by violently shrinking historical growth, negative free cash flow, and tight liquidity. It is a textbook battleground stock. Which leaves us with the ultimate question, the one you're going to have to answer for yourself after weighing this data. Will management be able to plug the hole in free cash flow and stabilize revenue, ultimately unlocking that massive discount? Or is Solventum just a melting ice cube, a classic value trap waiting to spring on unsuspecting bargain hunters? Take these metrics, dig even deeper into their business model, and decide for yourself. Thanks for joining me on this explainer, and I'll see you next time.